So now they've signaled it. Rates have started to come down. We expect this to happen in the next couple of weeks. The official announcement, there's a high likelihood that rates will continue to go down. Let's talk about 3 overall effects of what that will mean. First one that seems very obvious to me is we've talked about this idea of pent-up demand. Many people have been sitting on the sideline because rates are so high. They haven't made certain decisions in their life, whether it's moving or not moving or upgrading a house or downgrading a house. Investors have pent-up demand thinking, man, the media is telling me this is the all-time worst time to buy because rates are so high, blah, 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 blah. I expect the first reaction to be a certain amount of like it's like a dam, right? Like there's all this demand, it's just like dammed up. I expect this to be the first crack in the dam. Water's going to start spilling over, and demand for single family homes will rise. More people will go into the market, and there is going to be elevated transactional activity and a somewhat pressure of making faster decisions. How am I doing there? Is that about accurate on the demand?
Yeah, I think so. Anytime rates decrease by a substantial amount, interest rates on your mortgages decrease by a substantial amount, you always see mortgage applications rise. And then it translates into more sales 30 days later, 60 days later. That's just the way it works. The single greatest thing you can do to kind of increase activity in the real estate market is for the Fed to lower the Fed funds rate, because as interest rates come down, that spurs economic activity, that spurs mortgage applications, which spurs an increase in the number of sales. But here's the point I want to make. That's just like normal. Like anytime rates come down like that's normal. How long have we been having this discussion as an economy, as a country? How much focus have we put on when our rate's going to come down, when our rate's going to come down? I think there's credence to the fact that like there's a lot of emotion wrapped up into that. And so if there was ever a time that rate cuts were going to lead to increased buyer activity, it might be this time, just because of the focus, the amount of media attention and the headlines. And I mean, we're doing shows on this. So what do you think the average buyer is going to say at that point? They're going to say, well, now's a great time for me to buy. Also, because their home becomes more affordable than it was, before. So I think the amount of attention here is going to lead to more increased buyer activity, because we've already seen buyer activity increase in the last 2 weeks, 3 weeks, 4 weeks, as rates have started to come down and the Fed didn't move anything.
The way I see it is, we're talking about this idea of rates coming down, leading to increased activity in the market. It almost feels like holding your breath, right? Like as rates start to go up, as rates stay high, people are holding their breath. And it just so happens that we've been holding our breath for a really long time. And the longer time you hold your breath, the more you gasp for air when you let that out. And what I'm hearing you say is that corresponding to that, based on how long these rates have been going up and how long they've been held high, the response to a small rate drop is going to be a giant exhale and a giant gasp for air. Maybe not giant, but it's gonna increase activity. It's going to increase mortgage applications. It's going to increase transactions. It's going to increase competition for real estate in a very short amount of window, probably more than past times that rates have dropped, just based on the fact that we've been holding on for so long, waiting for something.
Yes. The facts are when interest rates go down, mortgage applications go up. Take all that other stuff that I just said off the table. Like when mortgage rates go down, mortgage applications go up, and then higher sales volume follows. So if that's all we get is a normal response to it, what you're going to see is more buying activity.
Okay. So that is the response to letting the air out of the balloon, increased activity. I correlate increased activity with more competition. What we talked about, this idea that if you're a retail buyer in the last maybe year and a half, you haven't been like competing for a house as much as you may have to.
Days on market, we're still 34 days on market in Jacksonville.
Yeah, that's true.
For this year.
Okay. All right.
So I mean, it will only increase. 34 days on market is low compared to historical standards. So that's prior to rates going down. So it will only increase that.
Okay. All right. So now that's demand, right? Like that is the pent-up demand piece. I was an economics major at University of Florida, I'll have you know.
Yes.
And I happen to know that when demand increases, price increases. right? That is the theory on demand and supply. Therefore, if we're saying that all this pent-up demand is going to be released onto the market, there's going to be an increased level of demand, it is fair to say that the next thing is going to be prices are going to go up. Am I right there?
Yes. Prices are going to go up.
Yeah.
So if you hold supply constant and you have more demand, prices are going to go up. It's not just the theory of supply and demand that we're talking about, which goes back hundreds and hundreds of years.
Mhm.
It's not just what you and I think. If you go back and you look at periods of time where interest rates have fallen a sizable amount, I ran the data to show if interest rates had fallen at least 1% over the course of a year, what happened to pricing? 5 out of 6 times. It's only happened 6 times in our country since we've been measuring this. 5 out of 6 times, home prices went up an average of over 5% the following year. And, that's something that shows you. And then the one time that it didn't was the Great Recession, which again is an anomaly, right? We openly talk about that. It's not perfect, but what caused the Great Recession was real estate, and real estate took the brunt of it. This is clearly not a real estate, caused recession that we are in. So you would expect the market to react the other times, the 5 out of 6 times, which show that home prices went up over 5%. So a lot of data, and it should just make sense to you guys too. If interest rates go down, homes become more affordable. If homes become more affordable, if the monthly payment of that home goes down, then you would expect more people would want to buy that same home. And so that's what we expect to happen. And, kind of connecting the dots there for us as investors is important because, as a country, this is still sort of new to us, or it hasn't been something we've experienced in a long time. And what I'm referring to is being in a place where your interest rates are high, we'll call it interest rates. Your interest rates are high, and the Fed is signaling that they're going to come down.
Yeah.
For a long time, we've been in a low interest rate environment, and we've been, I guess, sort of waiting for when those rates were going to come up. Well, when you're in an environment where rates are really high, you have to start to ask yourself, what effect does lowering the interest rates have on the underlying asset? And what it does is it increases the value of the asset because all the costs that are associated with owning that asset go down simply by your interest rate going down. So there's more inherent value in the asset. And so that's what we need to understand as real estate investors and put aside all of this noise, a lot of the noise that I talked about in our quarterly market update where people are talking about that sales aren't what they were in 2021. And all this noise about how does an election affect real estate and all this noise, put that to the side and just think about what happens to the value of an asset when interest rates go down. When interest rates go down, the value of the asset goes up. And that's what's going to happen in real estate.
Got it. So if I'm recapping some, it feels like the increase in demand will make buying properties a little tougher when there's already a constrained supply for most people, right? Like it feels like the rising in price is not coming from that as much. I mean, it could, right? Because competition raises prices. But what you're saying is that when rates go down, if I'm somebody that's looking to own a home, that means that my monthly payment per square foot becomes lower, essentially, right? Because I'm financing for X, I can, my payment is Y. If I'm a family with 2 kids and I'm looking for like 3 bedrooms or 4 bedrooms or whatever, I can now afford a little bit more home for the dollar because the interest rates are lower, and therefore there's space for that price to go up, while I still psychologically feel like I'm getting a better deal than before. And I'm much more likely to be like, oh, okay, cool. Now I can afford that extra half bathroom. Now I can afford that extra bedroom for my second kid. So I'm going to make the move because that rate went down.
Yes, absolutely.
Okay, cool. Now for the third insight into all of this, which to me is a new one. I started thinking, okay, demand is going to come in, right? So it's going to become a much more competitive behavior for average home buyers, for average investors, not so much for JWB investors because you have a supply, right? Like you're able to secure that and allow people to grow their portfolio. What's next will happen is prices go up for anybody that owns the asset already. We're seeing this like elevated home price appreciation. Anybody that hasn't bought it is going to have to pay a higher price. But as the interest rate goes down and it becomes more affordable for the retail investor, I'm taking the next transitive property and thinking, does that also mean that cash flows will increase for rental property investors, all things equal?
Yes, absolutely.
Okay,
Cash flows are going up.
explain that.
Let me actually give a couple of different scenarios. So let's say that right now, most clients are putting somewhere around maybe 30% down, maybe 35% down. And it's largely been there to make sure that you're cash flow positive. And the reason that has gone up from 20% down or 25% down and getting to 30 and 35 is because as interest rates went up, we as investors needed to put more of a percent down in order to stay cash flow positive. So now that interest rates are coming down, we're going to have an awesome choice to make. We can continue to put 35% down and have more positive cash flow because our interest rates have gone down, or we can put less down. We can put 25% down, which we haven't been able to do in quite a while, and remain cash flow positive. So if you put 35% down, you're going to have more positive cash flow. That might make sense for your goals. We would sit down and talk about that with clients. But for a lot of you, the biggest obstacle to adding to your portfolio is the capital needed to buy the investment property. So as interest rates go down, you can now be cash flow positive at 25% down. This is going to save all of you a lot of money that you don't have to outlay to buy your next JWB property.
Interesting. That's something that we haven't really discussed very much, right? This idea that over the last year and a half, if we wanted to stay cash flow positive year one, we were looking at saving up 30 to 35%, reallocating 30 to 35%, right? Like whatever we needed to like pick up a property, stay cash flow positive without having to go in the negative was a higher number than it is now. So for folks that have been waiting on the sideline to invest in this because they want to have cash flow positive on their next property and they only had X, now they have X minus a certain amount, right? Like minus that extra 35%. It's worth it to come kick the tires and see if that deposit, that money that you have set aside in your portfolio for this very high floor and a really nice high ceiling, if it's time to make it happen, you're able to get into this quicker than you thought for the last year and a half. Therefore, it's a good time to go to chatwithjwb.com, schedule a call, or shoot an email to info@jwbcompanies.com, or reach out to your portfolio manager if you're already a JWB client and say, oh, wait a minute, if I only had like 70 grand before and it wasn't getting me there, or like I only had 65 grand before and it wasn't getting me, or I only had 60, can we take a look at inventory right now? Can we price inventory right now before this like prices continue to go up now that the rates have dropped a little bit and see if I can get in there at 25%.
Yes, absolutely. You should. I mean, this might take $10,000 or $20,000 of capital. Keep it in your pocket that you didn't have to put out to buy that next investment property. So
$10,000 to $25,000 less in order to have positive cash flow, I think is a big number to throw out there.
Yeah, exactly. You're still positive cash flow.
Yeah.
The same place, right? All 5 profit centers are working in your favor. You're positively cash flowing, but you were able to keep, call it 10, 20, maybe even $25,000 in your pocket by going from 35% down to 25% down.
There you go. That's the value of coming live to the show. You just got a $25,000 tip right there from old Genius Concepts, generate cash flow over here. All right, GC. So summarizing, the 3 kind of insights are increased demand, meaning there is going to be if you are somewhere that's out there trying to acquire on your own, it's going to get tougher. There's going to be much more activity in the market. It's already low days on markets. It's going to move faster, but JWB has inventory if you want to go the not your average investor route. Increased pricing. If you already own right now, you are looking for some nice home price appreciation, but they're also, because the Fed hasn't fully done it yet, those things are still coming down. Prices will continue to go up. We expect that to continue to happen. So right now is a good time to buy if you want to lock in home price appreciation and potentially refinance later still, what we've been talking about. And then third of all is you can actually do it for maybe $10,000 to $25,000 less and still get positive cash flow is what I'm taking away from this It's Time announcement.
Yes. And I want to add one more thing. Somebody might say, all right, Greg, interest rates have come down a little bit, but if we're expecting them to come down more, why does it make sense for me to buy today when I know with a high likelihood that they're going to come down even more in the future? And here's the reason why, is because your amount of home price appreciation will be a lot more than the amount that it would cost you to refinance if you decided to do that down the road.
Yep.
It might cost you $3 or $4 grand to refinance, and to get that lower rate in, let's say, 1 year or 2 years, it might cost you $3 or $4 extra thousand dollars to do that. But if you waited until then, you might give up $10, $20, $30, $40,000 of home price appreciation to get there. So that's why buying now and then potentially refinancing later is the better strategy. You're going to make more money if you do that. And the sooner you do that, the more benefit you'll have.
Yeah, it seems like there's like a fine line in that sweet spot of like right now you can pay less and get positive cash flow. That's going to go away for that number that you're saving right now based on like the interest rate dip and the cash flow going up, because price is going to go up to match that. So like that discount that you're getting based on the interest rate is going to continue to like shift.
Right.
Right.
Exactly.
Got it. Again, chat with jwb.com, info@jwbcompanies.com. If you want to get into that conversation right now, lock that in, save $10,000 to $25,000, still secure positive cash flow, still have plenty of upside. Like Powell said, it's time.
Well,
all right.